activity index for February. Now, the January index was at 23, and the expectation was for a slight decline to, it was 0.23, excuse me, forgot a decimal point. So January's number was 0.23. The expectation was for a decline to 0.18 in February. Instead, we dropped all the way down to minus 0.19, so the opposite side of zero. So weak economy. The 3-month moving average, though, I guess, moved up a bit from minus 0.26 to minus 0.13, but the data was still worse than expected, and it does show a contracting economy. And that was before this financial crisis started, right? This is all rear-view mirror stuff. This financial crisis didn't kick off until March, so none of this is in the February data, which was already bad. Same thing with new home sales. New home sales were originally reported for January at 670,000. These are annualized numbers. That got revised all the way down to 633,000. That's a big downward revision. And then even after that downward revision, the February number was still weaker than expected, although not by much. They were looking for 645,000, and we got 640,000. But I would expect that even though mortgage rates may have come down a bit in this crisis, I think that this is going to send an even deeper chill throughout the housing market. Because a lot of these community banks now are having a lot of problems, and a lot of these banks are the ones that are writing a lot of these mortgages. So there's going to be a problem here for the housing industry. Kansas City Fed Manufacturing Index for March, not really sure here. It came out at a zero. It was, the last month was zero. I'm not sure if this number is correct. It looks like a weak number, but I don't really have much data on it. But I pulled it up. I already went over the balance sheet. Durable goods came out today, and another weak number. So the January number for durable goods was initially reported at minus 4.5. Came out at minus 5. So that number is now worse than they originally told us. They had expected an improvement in February. It was supposed to be positive 1.5. Well, they were right. It was an improvement, but it wasn't into positive territory. We got minus 1% for durable goods in February. So back-to-back negative numbers. If you take out transportation, they were looking for a gain of 0.3. Instead, we got 0. And core capital goods, which was supposed to come out, well, actually, I don't know what it was supposed to come out. It came out at 0.2. But we did downwardly revise the prior month, which was originally reported as 0.8, and it ended up being revised to 0.3. The one number that had some strength in it was the PMI that we got today for March. And so this has some part of March in it. And it came out at 53.3. I don't know what they were expecting, but I know that the manufacturing part beat expectations. It was supposed to be 47.2, and it came out at 49.3. Now, it's still sub 50, which still indicates contraction, but not as big a contraction. And the service number was much stronger. They were looking for 50.3, and we got 53.8, which was a much stronger number than forecast. And I think the main reason for that is prices. I think in the service sector, we're really starting to see momentum building in price increases. And I think that's really what's going on with that stronger number. I think it's just higher prices that are responsible for the increase. Now, there was a temporary decline in the goods prices because we had a decline in energy and other commodity prices as the Fed had tightened, and that was taking its initial effect. But now that the Fed has eased, right, now that there are no more rate hikes, yes, Powell raised rates by 25 basis points because I guess he said he was going to raise and he didn't want to not raise. But now that he's told everybody that he's not sure what he's going to do now, right? It's like we don't really know what's going on in the future. There's a lot of uncertainty. So he, as I said in my last podcast, he's opened the door to not hiking rates, which means he's not going to hike rates because the market is going to make sure that they push the Fed through that door and there are no rate hikes. So the rate hikes are over. The only question is, when is the next rate cut? and how low will the Fed be able to take rates. I don't think they're going to get all the way down to zero again. I don't even think they'll get down to 1%. They will cut rates. They're just not going to be able to cut them that much because inflation is going to explode. And so that will, shorten the easing cycle. But of course, as inflation gets worse, that accelerates the amount of ease because not only are you lowering rates, but real rates are dropping even faster because as you're cutting rates, inflation is going up. And so the gap between yield and inflation just widens. But we're going to cut rates. Haven't done that yet. But just telegraphing to the market that you're done. That counts as a pivot as far as I'm concerned. I mean, is it a soft pivot because they haven't actually cut rates? Maybe. I don't know. I just think it's about as clear a sign as you're going to get. So anybody who's still looking for a pivot, you're mistaken. You got your pivot. It's here, right? And so you're just risking losing a lot by waiting for some official pivot before you change your investment strategy, to a defensive one against inflation because you're waiting for the Fed to really start cutting rates or cranking up the presses. They've already done that, right? But when it comes to quantitative tightening, that's gone. And not only did they stop quantitative tightening, they started quantitative easing. So what more evidence of a pivot do you need than that when it comes to what they're doing with money? Now, the Fed is denying, as I said on my last podcast, they're denying that this is QE because they're saying the intentions are different. So that's what makes QE, what your intention is. So QE is when you print money and buy government bonds and mortgages if your intent is to lower interest rates. But if you do the exact same thing, but you have a different intent, well, then it's not QE. Well, that makes no sense whatsoever, right? So it is QE. I don't care what these guys want to call it. And the only reason they call it QE is because they don't want to call it the only reason they call it QE is because they don't want to call it what it actually is, and that is inflation. And that's what they've been creating, and that's why we have this inflation problem, and that's why this problem is about to get a lot worse because the Fed has no choice. And in fact, Powell admitted that in the Q&A in a way when he refused to give any economic advice to Congress. He refused to criticize any of their policies. He just said, we take whatever fiscal policy we get and we just build it into our model and we just do our best. Well, that means inflation. If they've just got to take any deficits that Congress wants to hand them and they got to figure out, how to deal with it, well, they're going to print money. I don't care what they call it, QE, it's inflation. Even if it's not QE, it's still inflation. It's about to accelerate. And so everybody needs to do something now. Don't wait. Do it now. Yes, the price of gold is still below 2,000. It got above 2,000 a little bit intraday today, but it did sell off. Let me see where it ended up closing. It couldn't hold 2,000. Gold sold off close to 20 bucks. So it closed at 1972. Still a pretty strong close. Gold stocks shrugged off the drop in gold for a change and actually were positive on the day. So investors are now starting to buy some gold stocks, realizing that they're still super cheap given where gold already is. But most of these gold stock investors still expect the price of gold to go down as soon as this crisis is over. And again, they think that inflation is going to come down. It's not. Inflation is going to run out of control. But gold is strong. Yes, it hasn't closed above 2,000 yet. It will. I don't think there's much downside left. I don't think we're going to see 1,800 again. I think that ship has sailed. So I think if you got your eyes on prices that low, you're not going to be a buyer. You got to be willing to buy stock, gold here in the 1900s. I think buying below 2,000 is going to be a good price. You're going to look back at this a year or two from now and think of how cheap gold was when it was still below $2,000 an ounce. So you want to buy some physical gold. I know the guys at Schiff Gold, they're still working overtime. They're working weekends. They're taking your orders at schiffgold.com and, talk to the representatives at Europe Pacific Asset Management about getting your portfolios in order, transferring your accounts over. I don't know how much time we have left. I mean, I really think we're rapidly approaching the end of this, where the window is going to shut, right? And you have to have your financial house in order. You have to have all of to coincide with the final day of the first quarter for the markets. But we had some connectivity issues here in Puerto Rico, and I lost internet. I actually had two services, and neither one of them was working. So finally got everything up and running. And so I'm doing the podcast today. Oh, but let me, I got to get something out of the way first. A lot of people have been waiting a long time for this, but, and I thought I would never actually, do this. I mean, it really is a major epiphany for me to have to admit that I was wrong for all these years. But I finally seen the light. You guys, I mean, all these text messages and emails, they finally worked because I seen the light and I am buying Bitcoin. Gold, forget about gold. You're right. It's old school. I mean, it's too clunky. It's too heavy. I want something with real value for the digital age. I finally, I was stuck in this mind frame, because I'm an old guy, I'm set in my ways, and I just couldn't, get with this new technology. It just took a long time for it to really sink in. I mean, some of you guys, you got it right away, but, it just took a long time. Now I'm 60 years old. And, so my brain doesn't work quite as rapidly as you 20-year-olds, right? So you were able to figure this out, quickly. But it just took me some time. I had to watch Bitcoin get all the way up, to 70,000, although it's pulled back right now. It's 28,000, something like that. But, I'm buying. You guys got me. So selling my gold. And I'm recommending that everybody who follows me do the same thing. Anyway, April Fool, if you believe that. Now, I know somebody is going to try to take what I just said as my April Fool joke, and they're going to cut it, and they're going to put it up on the internet as if it wasn't a joke, because that's how you Bitcoin guys operate. You like to take things out of context and misrepresent stuff. And so, yeah, I mean, you'd have to be a real fool to believe that I would be foolish enough to buy Bitcoin. Now, yeah, Bitcoin had a great quarter, and I'm going to get to that, but enjoy it while you can, because it's not going to be repeated. Because the real fools this April Fool Day were the people who were buying all these tech stocks during the first quarter, including cryptocurrency, Bitcoin, all this risk stuff got bid up in the first quarter of 2023. A lot of people got caught off guard by the strength that we had in risk assets in the first quarter, right? I mean, the NASDAQ, in fact, the NASDAQ had its best quarter since the second quarter of 2020. It was up 17%, I believe, on the quarter. And the reason that the NASDAQ did so well back in the second quarter of 2020, that's when the Fed, went back to QE. That's when they slashed interest rates back to zero because of COVID. Now, the market sold off early on when COVID first got started. But once the Fed went to zero and launched QE, infinity for QE4, that caused the NASDAQ to snap back very sharply. And so you have to go back then to find a quarter where the NASDAQ was as strong as it was in the first quarter of this year. Now, of course, the NASDAQ went way down. It was down about 30% for 2022. So big move down. It's not that crazy that we had a snapback. Plus, I think a lot of people were probably short a lot of these tech stocks going into the year. Certainly people who were short these stocks made a lot of money on those shorts in 2022. And so a lot of them were probably still there in 2023. And the expectation, of course, was that the Fed would keep hiking rates. And in fact, it did. We had 75 basis points of rate hikes during the first quarter of 2023. So that is what the markets had expected. And all of that, of course, had been bad for tech stocks. But the reason we got the sharp turnaround is because of the economic events, and most particularly the onset of the 2023 financial crisis that really changed the mindset. And I think even prior to the onset of this financial crisis, you were starting to see a bid in the tech stocks based on the idea that the tightening cycle was coming to an end. Yes, maybe the Fed was going to ratchet up rates a couple more times, but it didn't matter because the lion's share of the work had been done. And we were now on the cusp of another easing cycle. The Fed was soon going to be cutting rates. And of course, quantitative tightening would eventually give way to another round of quantitative easing. And so investors wanted to get ahead of that. Remember, the markets look forward. So they're looking beyond the last few rate hikes to the first rate cuts. And not just the first rate cuts, but the many, many rate cuts that are likely to follow, as well as the return to quantitative easing. And I think that is what is responsible for the big rise in the NASDAQ. And if you look at what happened with the Dow, for example, the Dow was barely positive. In fact, it may have been negative up until the last day of the quarter because the Dow was up 400 points on Friday, and the Dow only gained 0.4% for the entire quarter. So I think all of that gain was attributable to Friday's rise. So, but for that rise, the Dow might have had a negative quarter. But the S&P 500 was up about 7%, and what powered the S&P was the tech stocks that are large components of the S&P. Certainly other sectors of the S&P, like the financials, did extremely bad, right? The financials got clobbered, especially at the latter part of the quarter, but the tech stocks were strong enough that it outdid the damage done by the financials. But if you look at, let's say, the Russell 2000, which doesn't have nearly as much tech as the S&P or the NASDAQ, obviously, that index was only up 2.3%. So not nearly as big a bounce. Now, I didn't participate as an investor. I didn't own much of these tech stocks. Actually, I did own some of the Asian stocks. I had some tech stocks in Asia. Some of them are in our funds. So we caught a bit of the tech rally, but we're way underweight tech in general. But where we were able to participate was in the gold stocks, because the gold stocks had a decent quarter, not a spectacular quarter, but they had a decent quarter. The GDX was up 13% on the quarter, and the juniors actually didn't even do as well. They were up about 10% on the quarter. Now, for those of you who are shareholders of the Euro-Pacific Gold Fund, we actually did a little bit better during the quarter than both of those index. The Euro-Pacific Gold Fund was up 14.2% during the first quarter. So not nearly as much as the NASDAQ, although actually not that far behind, 17% versus 14%. So almost as good as the NASDAQ, but a lot better than the S&P, and certainly even more better than the Russell 2000 or the Dow. And what I think should be going on right now is more people who are buying these tech stocks should actually be buying gold stocks instead, because I think the gold stocks are the new tech stocks for this new easing cycle. The people who are buying tech stocks all quarter were correct in their judgment that we were coming to the end of the tightening cycle, because we were. And they were correct to anticipate that there would be an easing, which there already has been. I mean, the Fed has already acknowledged that it's probably not going to hike much, if at all. And whether they want to admit it or not, they're back to quantitative easing. Although this week on Thursday, when they reported the balance sheet, it actually shrank again by about 25 billion. So we didn't have a third week in a row of an expansion. There was a little bit of a contraction, but I think that is the exception, not the rule. I think going forward, we're going to see the balance sheet continue to expand. Every once in a while, there may be a weekly contraction, but the direction now for the balance sheet is up. But I think investors are wrong in thinking that this easing cycle is going to be good for tech stocks. I think they've got it wrong. The last easing cycle was great for tech stocks, but I don't think that we're going to repeat that. I think this time around, it's going to be gold stocks. And in fact, if you go back to the 2000 bubble that popped, and Nasdaq was down 80%, mostly because of those tech stocks. The tech stocks rebounded from 2002 to 2008 when we had the financial crisis. But the gold stocks did much better during that easing cycle because the Fed moved rates down to 1% and then kept them there for a while and then gradually normalized. But during that entire cycle, the gold stocks actually did much better than the tech stocks. So I think the same thing is going to happen this time. It's not going to be the people in tech stocks are going to make money again like they did from 2009-ish all the way through 2021 or whenever that bubble finally peaked. It's not going to be the same, nor is it going to be the crazy days of the COVID lockdowns where all these tech stocks, went ballistic. Because what I think investors don't get is that inflation is the wild card. To sell, all that counts is your dividends, how much you're earning in dividends. But I know that gold stocks are going to be much higher in the future than they are right now. So I want the price to go down right now so I could buy more, right? If you had, you had a time machine and you had the price of a stock 10 years from now and you knew how high it was going to be, you would want it to go down before then because you just want to buy more if you know where it's going to be. Well, I don't have a time machine. I don't have the newspaper from 10 years into the future, but I don't think I need a time machine. This is so obvious that I can see it in advance. And so I'm so convinced that these stocks are going to be much higher in the future. I want them to go down now, even though I already own a bunch, because I'm still earning money. I have to invest it somewhere. I'm not going to spend it all. And so I want to buy more of these stocks. So I think we might get more of a pullback there, but not as significant as what I'm looking for in the overall stock market. Next, I want to talk, though, about the debt ceiling. That was the topic mainly of my last podcast. I talked a lot about the debt ceiling, brinkmanship, and all the political theater involved in the debt ceiling. Well, today, some of the actors came out and took a bow. The Republicans actually passed a bill to raise the debt ceiling. They're going to raise it by $1.5 trillion, which is nothing. I mean, maybe that'll buy them 6 months, right? I mean, because the deficits are over $2 trillion a year. So raising it by $1.5 trillion, they were doing that, years and years ago when we only had $400 or $500 billion deficits a year. When you're running deficits of over $2 trillion a year, a $1.5 trillion increase in the debt limit doesn't really get you much. Now, personally, I would just assume the debt limit not go up. I want the ceiling left so that we could really start dealing with the debt and paying our bills instead of, putting more of our unpaid bills on a credit card. Well, the Republicans have passed a debt ceiling increase, but the Democrats in the Senate are not going to pass it. And even if the democratically controlled U.S. Senate passed it, Biden ain't going to sign it, right? So it's dead on arrival. And the reason that the Democrats don't want to sign it is because they say it's heartless. They're slashing government spending. This is terrible, right? The Republicans are punishing America with this increase. We want to just increase the debt ceiling, just a clean bill to increase the debt ceiling, as if that doesn't punish Americans. Who does Biden and the Democrats, who do they think is responsible for repaying all this debt? It's not like Americans avoid being punished if we don't make them pay now, if we let them pay later, because they're going to pay more later. Increasing the debt punishes the American people who are on the hook for repaying that debt. So if we really want to do the American people a solid, we should not raise the debt ceiling. We should reduce the burden of debt that we are placing on them. But Biden and his buddies in the Democratic Party want to pretend that the average American, the middle class, is getting away with something. If we just keep increasing the debt ceiling, then the average American never has to cover the cost. Like these bills are just going to be paid, by Santa Claus or the man in the moon. No, the American public, the middle class, are responsible for all this debt. And so the responsible thing to do is to stop adding to that burden and deal with it. But the Republicans don't even do that because, first of all, there are no real cuts. The only cuts that are happening are in discretionary spending, right? So that means that all the non-discretionary stuff, Social Security, Medicare, national defense, none of the cuts apply to national defense, interest on the debt, none of that's getting cut at all. That's 70+% of the budget. So if you're not going to cut 70% of the budget, even if you cut the other 30%, you're not going to make much headway. But the other 30% doesn't really get cut. What the Republicans are saying they want to do is limit the increase in that spending to 1% a year. Remember, I talked about how the government's version of a cut is you increase spending by less than you had planned on increasing it, and they call that a cut, right? Well, in reality, that's still an increase. It's just a smaller increase. Now, in a way, if you only increase discretionary spending by 1% a year, and if inflation is 6%, 7% a year, well, then in real terms, spending is being cut. And that would be the case. And the people who were getting these government benefits would feel the pain of the reduction in the real purchasing power of whatever money they were receiving from the government, because it wouldn't keep pace with the increase in the cost of living. So in a way, yes, it's a little bit of a cut, but it's not nearly enough to get us to where we have to be. As I mentioned in my last podcast, given the fact that we have over a $2 trillion annual budget deficit, in order to balance the books so that we stop burdening Americans with even bigger debt, which they have to repay with interest. So obviously, if you have to repay your debt with interest, it's more expensive than just paying for the spending right now. So either we have to cut spending by a third, right? 33% cut in everything, which includes Social Security and Medicare and national defense. And if you're not going to cut those, then you got to pretty much abolish everything else. You have to eliminate completely the discretionary spending. If you're going to take Social Security, Medicare, national defense, and put them off the table, well, you just got to get rid of everything else. And I don't even think that even balances the budget. Alternatively, if you don't want to do that, you can raise taxes. It would take, I think, about a 40% increase in taxes to balance the budget. That's how much Americans are undertaxed relative to what the government is spending. Think about that. A 40% increase in every tax that you pay. So the Social Security tax would have to go up 40%, payroll taxes. Medicare tax up 40%. Your income taxes would have to go up 40%. That is an enormous increase. And of course, they might actually have to go up more than 40%. Because if you raised income taxes and payroll taxes by 40%, you would not get 40% more revenue. That would actually harm the economy. It would cause the revenue that you're taxing to go down. Incomes would go down if taxes went up that much. So in order to get an extra 40% in tax revenue, well, you might have to raise taxes by 50 or 60%. But again, that would destroy the revenue even more. I don't think it's even possible. How much they would have to raise taxes to balance the budget is so big that it can't ever work because of the economic impact and the adverse consequences those higher taxes would actually have on the very thing that you're trying to tax. So most of it is going to have to come from spending cuts, but real spending cuts. But the Democrats won't even sign on to these tiny spending cuts that the Republicans are proposing. Biden and the Democrats are saying these are draconian, these are heartless, this is going to destroy America. We're not going to vote for this. Instead, we'd rather destroy America with debt rather than destroy them with spending cuts. Anyway, it was for Trump to beat Hillary Clinton in 2016. Anyway, what I want to wrap up this podcast, though, talking about is Tucker Carlson out at Fox News. Two of the guys whose shows I was on the most, Don Bongino and now Tucker Carlson, are both gone from Fox. I used to do both their shows. Now, maybe that means Laura Ingraham is next. Hopefully she sticks around because she's the only person left on Fox News who has me on. Now, I go on Fox Business. I go on Liz Clayman's show. I go on Charles Payne's show. So that's another network. But Fox News, which has a bigger platform, there were 3 shows that I go on, and now 2 of the hosts are gone. But by far, I think Tucker Carlson was not only the best host on Fox, he was the best host on any news network, cable or broadcast. He was by far the best. In fact, I talked a lot about his recent podcast about the dollar's reserve currency status. But more than that, I mean, he called out all the hypocrisy regarding the war in the Ukraine and COVID. I mean, so many things. And when they were doing the George Floyd stuff, and I mean, so many things, he had the guts to come out and speak the truth. When nobody else wanted to speak the truth, everybody else in the mainstream media wanted to be politically correct. They were kowtowing to all of that pressure. And Tucker had pressure because a lot of advertisers who would have advertised on his show, the number one show on cable news, not just the number one show on Fox, the number one show in all of cable, right? But some advertisers were afraid to advertise because they're worried that some left-wing nut is going to boycott them because Tucker Carlson is telling the truth. When you're telling lies and there's someone out there telling the truth, you got to silence that person, right? You want to be able to tell your lies and have other people not call you out, right? And he had a big soapbox to call out all these lies. And he had a lot of people, a lot of fans, myself included, who enjoyed watching his show because he was very unique. Now, of course, I'm like Tucker in that respect, but I'm just here on, Peter Schiff show. I don't have a Fox News platform. I'm not the host of a show like that. His audience is more than 10 times as big as my audience. And, it's easy for me to speak the truth. I mean, I gotta, give it, applause for Tucker because to speak the truth in that corporate environment, knowing what the consequences are, right? I'm my own, right? I mean, I can speak my mind. And yeah, maybe they ended up shutting down my bank. The media destroyed my bank because they didn't like what I said. But I can't get fired, right? I mean, because I don't have a boss, right? I'm just direct to my audience. I'm not dealing with a big corporate structure. But he was in that world. And even though he was with Fox, yes, Fox is Republican, but they're not libertarian Republican. They're, mainstream, George Bush, military industrial complex. They're not Tucker Carlson. Tucker Carlson pushed the envelope at Fox, right? And that's the reason that he was so hated. I mean, you look at all the people that are celebrating and popping the champagne because Tucker Carlson was fired. Look at all of his enemies, because his enemies, the people who were Tucker's enemies, those are the people that you want to be your enemies. When all those people are celebrating that you've been fired, Tucker was doing a good job. He was an important voice that needs to be heard. And it's a shame for Fox that they caved into the political pressure because you don't know why they fired him. Yeah, they got this big lawsuit from Dominion that they settled, the defamation lawsuit, but that wasn't Tucker's fault. Tucker didn't do that. So I don't know what else was a catalyst, but I think the problem was they were worried about Tucker and the things that he says because of how honest he is at calling out the hypocrisy and the lies of the establishment, of which, Fox is part of the establishment. Now, they're not nearly as bad as CNN or MSNBC or ABC, CBS, NBC, all those, but they weren't Tucker. Now, they allowed Tucker. To their credit, Fox allowed Tucker to speak his mind for as many years as he did. But at some point, they must have decided that it was too much for them. But I think that this is going to end up being a loss for Fox News. It's not going to end up being a loss for Tucker Carlson because there is a big market out there for what Tucker Carlson is saying. You know, there are a lot of people. I mean, I tap into part of that market myself, so I know that it's out there, and I know that he can reach it. He doesn't need Fox News. He's got a big enough audience already, and Fox News certainly helped him cultivate that audience. I mean, I can imagine the size of the audience I would have if I had a multi-year run on Fox News. I mean, I think I could have a very successful program. Plus, he's got a whole bunch of writers and producers. I do it all myself. I mean, so I just make it up. I don't have people writing scripts for me and stuff like that. But I'm sure if I was up there on that big a soapbox, I'd have a big audience too. Maybe not as big as Tucker's. I don't know. But he's got a great audience that he wouldn't have had. But he can take that audience, especially with the internet and social media. He doesn't need to sign a deal. I mean, there are other broadcasts. He could do One American News. He could do Newsmax. He could do something with the Daily Wire. But I think that he should just go out on his own. I mean, he could. I'd love to do something with Tucker, but Tucker don't need me. He doesn't need anybody. He can do it all himself. And I look forward to being a guest on the Tucker Carlson show whenever he starts producing it. In the meantime, I think Fox is going to lose a lot of viewers. There are people that are pissed off, and rightly so. I mean, my mother, I didn't put her up to it. My mother, who's a big fan of Tucker Carlson, she tells me, I'm never watching Fox again. My wife doesn't want to watch Fox either. It's like we can't turn on Fox News. My mom canceled her subscription to whatever. I forget what I don't subscribe to it, but my mom subscribes to some paid Fox Now, or I forget what it's called. But she says, I'm canceling it. And if my mother is doing that, I mean, I'm sure that lots of people's mothers and fathers and sisters and brothers are having a similar reaction. They're just really upset. They feel like Fox sold them out by firing Tucker, and they want to show their support for Tucker Carlson by, boycotting Fox. And, a lot of people that tuned in to Tucker Carlson's show, 8 to 9 o'clock, well, they watched 9 to 10, right? They stuck around. So Tucker's show and his popularity benefited the shows that came later. Well, now they're not going to get the benefit of Tucker's audience not turning the dial because Tucker's audience isn't going to be there. And there are a lot of other alternatives to Fox News now and other ways that people can get Tucker. So all the people that are out there that are so happy that Tucker Carlson is off Fox News, be careful what you wish for, because he may even be more effective and speak even more freely. I mean, imagine the stuff that Tucker Carlson said when he was still under that Fox News umbrella. Imagine what Tucker Unleashed is going to say. I look forward to that, and I wish Tucker Carlson Godspeed in his new adventure in this next stage of his career, which I think will be the best yet. Anyway, thanks everybody for listening, and don't forget,
My 401k, yep, better than being in stocks, but that's just for now. As I said, the biggest losses are going to be the people who are in cash, people who are in T-bills. Oh, the market's already closed. Look at how much time this is. I didn't realize we were after 4 o'clock. Dow ended up down 582 points. That's 3%. But they sold off the gold stocks into the close. So the GDXJ only up 6.7, or GDXJ up almost 10. But let's look how some of the individual larger mining stocks were. Newmont up 2.7, not much move there. Barrick Gold up 6.7, a bigger move there. Let me see, Yamana is a mid cap, that's up 9%. All these stocks are way off their highs. Goldfields, South Africa, up 15% on the day. So a bigger move. Kinross was up 9.5%. All these are good moves, but they all sold off on the close, which is pretty common. I mean, I watch the gold stocks quite a bit, and I still think there's a lot of selling on the close. And that's because a lot of the buying in the gold stocks is day traders, right? There's still no real money that has moved into this sector. You get some day traders that get long in the morning, they ride the rally up a little bit, and they want to close out their positions. They're trading on margin. They don't really have enough money. So this is all a bunch of noise right now. When the real money, when the institutional money starts moving into these stocks, when they finally figure out what I've known for years, and everybody decides that they need to have some gold stocks in their portfolio, these things are going to explode, right? If I'm right. I mean, they're not going to just go up 9 or 10%. I think we're going to see some days where you see 30, 40, 50% moves in big gold stocks because some big brokerage firm put out a buy recommendation on one of them. Oh, everybody needs to buy this. Nobody owns these stocks right now. See, once the institutions think it's safe to buy, once buying gold stocks becomes the conventional wisdom, then everybody's going to do it. See, right now, it's like, I don't want to go out on a limb and buy gold stocks because nobody else is doing it. And if I buy a gold stock and it goes down, then they're going to say, why'd you buy this idiotic gold stock? What are you, some kind of kook? What are you, like a Peter Schiff? You're fired. Get out of here, right? But if everybody else buys a gold stock and you buy it and it goes down, well, you're covered, right? Because you just did what everybody else does. If everybody else starts buying a gold stock and they all go up and then you don't buy one and then your shareholders be with you, what are you, an idiot? Why didn't you have a gold stock? Everybody else bought a gold stock. What are you, got a moron? You're fired. So once everybody buys them, then everybody wants them. And of course, by that happens, the price goes through the roof. I don't want my clients waiting for everybody else to buy. I want to buy before the herd, not with the herd or after the herd. Let me see how many more questions I have because it's already past the time I wanted to stop. All right. I mean, when did I start at 1? Yeah. So all right, I'll go till 5. That'll be 4 hours. Can I get a little bit more water? As I said, these are like telethons, you know, like the Jerry Lewis telethon, except I'm not on my feet the whole time. But you see me, I squirm around on my seat because my butt gets sore just sitting in this chair for all this time. I got to like take some of the pressure off by getting up a little bit. But I'm sure I know I'm going to have a lot of calls to make because I'm getting a lot of messages and stuff. I got voicemails on my phone. So when I finish this, I'm not done working. I got stuff to do because, you know, I've spent 4 hours doing this podcast video and now I got extra work. My birthday is, I'm going to be working my ass off on my birthday here. Let me see. Hey, Peter, U.S. experiment with MMT. Yep. Modern monetary theory. Yep. Nothing modern about it. It's really not monetary, and it's not a theory because a theory you have to like have the, you know, presume it is viable. Now, it could look viable in the short run. Yeah. And that's what makes people think it could actually work. But it's all an illusion. It doesn't work. It just makes problem bigger, but they're hidden from view. But then when they blow up, you have to find something like the coronavirus to blame it on. Eric, what will trigger the loss of confidence in the dollar? It's going to be just a loss of value. At some point, prices will be rising fast enough that people will lose confidence. And it all is a confidence game. It's a con game. That's the only thing that really backs up the dollar, is confidence in its future purchasing power. And once the confidence is lost, there's really no way to restore it. It's a death spiral. And I think, unfortunately, the dollar is going to die. And the only way to resurrect it will be if it's backed by gold again. That'll be it. And the dollar initially is defined as a weight of gold. That's what a dollar was. It's a measure of gold. The dollar actually describes a measure of gold. How much gold you have. So the dollar is a weight of gold. That's what it is. We turned it into just a piece of paper, but that's not what it's supposed to be. But that's what it needs to be again. Love your podcast, Peter. This is love your podcast. Do you think wages will rise anywhere near fast enough to keep pace with hyperinflation? Not a chance. All prices will rise in hyperinflation, including the price of labor, wages. But a lot of people are going to lose their jobs in hyperinflation, so their wages will be zero. And their unemployment checks will not rise nearly as fast as inflation. But even people who have jobs, wages will lag the cost of goods. So everybody is going to be impoverished through inflation. The stocks will go up more than the price of gold, right? I think a lot of the foreign stocks that I have could go up more than gold. And I think they'll deliver good dividends that you can live on. So this is what we're doing. I'm building portfolios that I think will outpace inflation because there's no way your wages will or any of your government benefits. Paul, can you bring me water? I really need some more. All right, let's drop. Happy birthday, Peter. I heard you mention that you would be hiring asset management in Puerto Rico. Yeah, there's nothing on the website about it. You just got to send an email if you're in Puerto Rico or you're thinking about moving to Puerto Rico. It's really good if you're in the business, you have a license or something. But you can email Paul at schiffradio.com. But yeah, we don't have anything on the website because we're not. I don't know how many people we're going to hire. We'll see. But we're not even in Canada. But I can still use a couple of people. But I'm talking to a couple of people right now, so I'm not really sure. But obviously, over time, we'll be hiring people. So it can't hurt to send us your information. Could we be on the path to a guaranteed basic income? Yeah, we might have the guaranteed basic income. That was a campaign issue for Andrew Yang, and all of a sudden you got Republicans, Mitt Romney, who was the presidential candidate who lost to Obama. He's advocating some kind of basic income. I don't know if it's a permanent thing or just a coronavirus emergency. But look, the problem at some point is going to be the checks aren't going to buy anything. What good is it if you have a basic income if your basic income doesn't buy you anything? That's the problem. Now, there are other problems with it, but that's the biggest. If we're going to have hyperinflation, none of this is going to matter. Your income isn't going to matter. It's what you can buy with that income that's going to matter. Thoughts on the British economy? I had a lot of thoughts on the British economy. Don't have enough time to really address them. I think they're better off leaving the European Union. I would have been in favor of Brexit if I was over there. But what they need is less government, right? Part of the idea was they didn't want to deal with all the government in Brussels, which is good. There's too much government in Brussels, but there's too much government, from down at 10 Downing Street or from Parliament. It's not that the British needs less government from Brussels. They need less government there in London. They need a smaller government. And so they need more freedom. They don't need bailouts and stimulus and artificially low interest rate and inflation. The Bank of England's drunk from the same Kool-Aid. They're pursuing the same irrational monetary policies. The one good thing that's going to come out of this is at the end of this, when we have this currency crisis, all of these guys, their reputations are going to be destroyed. Their theories are going to be completely and utterly discredited. And so hopefully we'll be able to, have sound money and have a rethinking of all this. And so that maybe we'll embrace sound money again and have, the conventional wisdom actually be wise instead of completely idiotic, which is what it's degenerated to. What books or chapters have been the most insightful? Look, I don't know. I read, as a kid, I read Rothbard, and I said I read Hazlitt. I read Ayn Rand. I read Austrian free market thinkers, libertarian, older philosophers, and I had my dad. I read my dad's book, The Biggest Con, and the book that I turned into a book with my brother, How an Economy Grows and Why It Crashes. His was How an Economy Grows and Why It Doesn't. Kingdom of Maltz, my dad. We still have copies. I don't know how many we have left, but you can go to my website, schiffbooks.com, and get. I still have some copies of the Kingdom of Maltz that my dad wrote. I don't have any copies anymore of The Biggest Con. You can find a few on eBay or Amazon. I don't have any to sell. I have a few, but I'm not selling them. I want to keep them. but I still have a few of the Kingdom of Wallace's left. And we have our own books. I think, or you can go on Amazon and order my books, Crash Proof. Crash Proof 2.0 is the more recent one. Get that one. The Real Crash, the revised edition. You can get that on Amazon, or I think I have a link to that through shiftbooks.com. And then if you're going to get How an Economy Grows and Why It Crashes, try to get the collector's edition if you can. If not, just the regular edition is a little cheaper. But I think they're all kind of discounted now on the online booksellers because they're older. They're several years old now, but they're very, very valid. They're in fact they're probably more relevant now than they were years ago. Agree the U.S. dollar will decline, but where will foreigners end up parking their cash? Yeah, well, they'll get out of dollars either into other currencies that they think are less bad, or in gold, in silver. A lot of the cash isn't going to be parked. It's going to be lost because when the dollar crashes, a lot of wealth is going to evaporate with it. So people will lose that. But what they're able to get out before the music, also my computer froze up. All right. If they get out before the music stops, yeah, and they'll put some into stocks, into equities, into other assets, into real estate, whatever. But I mean, a lot of money just disappears. If you were in your 30s and had $500,000 that you can get with a couple of weeks, what would you do with it? I would send it to me. I would open up an account at Europe Pacific Capital and invest that $500,000. I would talk to one of my representatives and get a plan. Like, let them know all of your particulars, all of your your goals and your objectives and things like that. And help. And I can manage that portfolio. If my strategy is suitable for you and my representative, we can determine that suitability, then yeah, I mean, get invested, and you can talk with him about which type of strategy. A separately managed account, a wrap account, certain funds, brokerage, app managed, whatever. But go to europac.com and call the 800 number, or just fill out a form to have a broker get a hold of you. And congratulations for being in your 30s and having any money. I mean, most Americans are broke. They don't have $500, let alone 500,000. So that's good. But what you need to do is preserve the purchasing power of that 500,000, because one day $500,000 may mean nothing, right? It may be just pocket change. So before that happens, preserve it by spending it now, not spending it on consumer goods that will depreciate, but acquire real assets that will hold their value, potentially appreciate, and pay dividends. If you were 22 in Canada, had about 200,000, what would you do? Again, is that California? No, I think that's California. Yeah. No, Canada. Well, yeah, I mean, send it to me if I could. I mean, I'll be in Canada soon. Just let my representative know that you're a Canadian. In the meantime, you can buy some physical gold up there or something. But yeah, send an email to us. Go to Europe Pacific assets, or EuropacificFunds.com. Anyway, I'm out of questions. Oh, well, that's a good thing. Anyway, since I got to all the questions, I think I'm just going to end the podcast. I'm out of questions, right? Because there's nothing left for me to read.
Yeah.
All right. So I'm going to end it. I'll cut it a little short, so I won't go the full 4 hours. But as I said, there's a lot of good stuff in here. Hopefully, people can actually sit through and listen to the entirety of it, because I answered questions, but all throughout, I interjected a lot of important stuff, which, I mean, maybe we can even grab some of that important stuff and piece it together and make a shorter video out of that, so that maybe people, that can't, sit through 3.5 hours. But I know people listen to the Joe Rogan's podcast. It's 3 hours, sometimes closer to 4 hours. So yeah, I mean, especially now, when a lot of people don't have anything else to do. And again, the airwaves are filled with a bunch of nonsense. The news, financial and regular news, everything is wrong. All the opinions are wrong. I mean, maybe, once in a while a guy like Jeff Gundlach comes on and says some things that are right. But even he sugarcoats it a lot. He may be, dumbing it down for the audience. Maybe he's afraid to say some of the stuff that I'm saying. Although I don't think he's quite as bearish as me. But I think he's probably closer to me than the mainstream. That's how ridiculous the mainstream is. But most of the people that come on, I mean, just complete nonsense. They're just talking to bail themselves out. I mean, they're trying to save their own butts from mistakes that they made, and they need these government bailouts. And they're trying to pretend that it's for the country. Or maybe some of them actually think it's for the country. Again, a lot of these guys don't know, right? They're drunk on the same Kool-Aid as everybody else. They actually think that bailing them out actually bails out the country. They don't understand how capitalism works. I mean, which is very frustrating because you have some of the most successful people in capitalism, people who have made billions, right, in at least a somewhat capitalist economy, having absolutely no understanding at all of the system that helped make them rich. Now, the problem is a lot of the guys on Wall Street, the hedge fund guys, they didn't get rich because of capitalism. They got rich because the central banks polluted and destroyed capitalism. And as they did that, as they siphoned all the capital out of Main Street, they enriched a lot of these speculators on Wall Street. So it's no wonder that they don't understand the problem, right? Because they got rich off the problem. So they don't want the problem solved. They want the problem perpetuated. Bye for now. And again, thanks everybody for contributing and for wishing me a happy 57th birthday. Bye-bye.
Thought that, oh, you know, it would be bad if they didn't raise the debt ceiling. No, it's bad if they do. And again, this should be good for gold. Raising the debt ceiling means more debt, more inflation. That is positive for gold. You know, gold has had a pullback recently. I'll get to that a little bit later in the podcast. But all of this should be bullish for gold and bearish for the dollar. Another piece of economic news that we got last week, again, real bad. I mean, almost all the news was worse than expected. I'm just focusing on a couple of ones that were particularly problematic late last week. The Chicago PMI, right? That was supposed to be 47. It came out at 40.4. Actually, no, that is today's data. That number came out today. I jumped ahead of myself. Hold on, I got my my slides mixed up here. The Richmond Fed manufacturing. Let me talk about that one first because that was last week. That was supposed to improve from minus 10 in April to minus 8 in May. And instead of improving, it got worse. It went to minus 15. So it was already bad at minus 10. And then it came out to minus 15. Now we know we're not manufacturing because that's one of the reasons that our trade deficit went up. That's one of the reasons our exports went down because we can't export stuff that we don't make. And if we're not making stuff, well, that's going to be reflected in these weak manufacturing numbers. And that is exactly what's happening. The other data point I wanted to talk about from last week that came out on Friday, which was one that the markets did pay attention to, unlike the trade deficit, which, you know, they completely ignored. And that's the personal income and spending numbers. And the income number was pretty much in line. It was up 0.4. But the spending was up double estimates. They were looking for up 0.4, and we got up 0.8. Now, why are Americans spending so much more money? Well, obviously, it's because stuff costs more money. That's the real reason that spending is going up, because prices are going up because of inflation. And in fact, even in the data, the PCE, and apparently, you know, this is the Fed's favorite way to measure inflation. And that's because it's the least accurate, right? It's the lowest number because it has the most substitution and hedonics and, you know, sleight of hand. That's why the Fed likes it, because it, you know, it puts the best possible spin on inflation. But even those numbers, they were looking for the month over month PCE to go up by 0.3. It went up by 0.4. But more important, the prior month in March, it was only up by 0.1. So we went from 0.1 in March to 0.4 in April. Despite the rate hikes, these numbers are going in the wrong direction. The same thing for the core. The core PCE was supposed to go up 0.3. It went up 0.4 versus 0.3 in the prior month. And look at the year-over-year numbers. Last month, the year-over-year increase in the PCE was 4.2. Now it's 4.4, higher than the 4.3 expected, but more important, above the 4.2, going in the wrong direction. And if you take the core year over year, stripping out food and energy, again, 4.7 for April. It was 4.6 in March, going in the wrong direction. Inflation numbers are getting higher, not lower. So how has the Fed made progress? How are we moving inflation towards 2%? when it's moving in the opposite direction right now, and rates are already at 5.25%, and we're potentially going to get another rate hike in a couple of weeks during the June meeting, when rates are going to be 5.5%, 5.75%, right? Adding to the inflationary pressures that are already in the economy, because we are increasing the interest expense that everybody has to pay on the enormity of debt that already exists. Now, I want to get to the data from this week. I just started with the Chicago PMI. I already kind of let the cat out of the bag on that one because I read it off. But again, I'll say it again. That came out earlier today, and it was a horrific number. This is like the worst Chicago PMI, since the financial crisis. It was supposed to be 47, a little bit down from the 48.6 in April, and it plunged to 40.4. I mean, the low end of the range was 44.5, and we're a full 10% below that number. This is a horrific number for the Chicago PMI. And of course, we've been down, I forget, something like 13 or so months in a row. So we've been in recession for a long time, according to this number, and it's actually getting worse. Now, when this number came out initially, there was a sharp rise in the price of gold, about $10, $12 immediately. Gold spiked when this number came out because this is bad news on the economy. But then about 15 minutes later, we got the JOLTS report, and then gold lost almost the entire rally. Didn't quite go negative. It went, from up like $10, $12 to up maybe $2 or $3. As soon as this JOLTS number came out, which kind of boggles the mind because the JOLTS number showed a huge increase in the number of jobs, openings, over 10 million. It was 9.59 million in March. And that was revised up to 9.745 million. And the consensus for April was for a drop to 9.35. I mean, why do people think this? Well, people are losing their jobs. All these layoffs are being announced. People are, losing their jobs. And now you have all, people implementing or starting to implement AI, and you're getting some job losses there, but you have job losses in the banks and the financials, and a lot of these companies, money-losing companies, are having to cut their burn because they don't have access to capital. So people expected the number to come down. Instead, it went way up, which makes no sense. I don't even believe these numbers. One thing in this is they give you the so-called quits rate, which, lets you know how many people are quitting their jobs, and that went way down. And so that doesn't show a strong economy because normally, you don't quit your job unless you think it's easy to get a better job. So in a strong job market, people are likely to quit, right? But if the job market is weak, you're kind of going to stay put. You don't want to take your chances in the labor market because you may not get something as good as the job you have. And so the fact that the quits rates are going down would suggest that the labor market is not really as robust as this JOLTS report would suggest. So, but this is the only really strong number that we've had in the last week and a half. I mean, we've had a couple of numbers that might have been slightly in line or a little bit better, but not like that. But most of the numbers have been like the Chicago PMI, maybe not quite as bad as this one, but they've been worse than expected, and they're all flashing recession as the Fed is hiking rates and as inflation continues to get worse. But meanwhile, the markets in the month of May have been oblivious to all that, right? They're not paying attention to any of the stuff that's really going on. Nobody sold in May and went away, unless you're talking about people who own gold stocks. But May was a huge month for the stock market, particularly the NASDAQ. I want to go over that. So the month of May, which ended today, this was the last day of the month, and the NASDAQ was up 6% in May, 6%. And if you look at the NASDAQ 100, right, the QQQ is the ETF for the NASDAQ 100, the biggest NASDAQ stocks, that was up 8% in the month. That's it. I mean, it's a huge number, led by NVIDIA, right? NVIDIA was the biggest gainer. It was up 36.5%. And that was with like a 5% decline. I think it was down today by that much. Let me just I'm going to take a quick look at it. 5.6% on the day. But even with that decline, you still had like 36.5% increase on the month. And you had other stocks, Google, Meta, a lot of these big stocks that are perceived to be the main beneficiaries, the initial beneficiaries of the AI revolution. Those stocks saw the biggest inflows and the biggest gains during the month of May. Now, if you take those stocks out of the game, there really wasn't much going on. In fact, the S&P 500 was only up about 1/3% during the month. All of those gains attributed to the big tech stocks that are part of the S&P 500. If you look at the Russell 2000, which doesn't have all these tech stocks, it was down 1%. The Dow was down 3.5%.